The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ. And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettler, along with Accunet Mortgage and Accunet Realty Advisors owner and president Brian Wickert and licensed millennial loan consultant David Wickert. As always, if you have a question or would like to share something with us, you can do so at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620. So we're focusing in on appraisals this weekend.
Yeah, and I picked this one up off of kind of a question and answer board online, but it does come up here in our practice in southeastern Wisconsin and elsewhere, and that is, hey, what if I get an appraisal waiver? We give them the good news. Hey, you're buying this house, Fred, and guess what? We just put your information through Fannie Mae's automated underwriting system, and it says we don't need an appraisal. And boy, the people go, really? Wow, that's surprising. I thought I had to get an appraisal. Well, some people are. Some people are. And so this person was questioning on this Q&A board, which I submitted an answer to, as to whether they should still go ahead and get an appraisal. And David and I were talking about this before we came on the air, I squarely came down on the side of, are you kidding me? Save the money, right? Because it's going to save you $450. A purchase. Oh, yeah, you didn't know I was talking about a purchase? I'm talking about a purchase. On a refinance, it's a slam dunk no-brainer. Correct.
For a seller, hey, if you want to protect yourself still as a buyer, you could make a cash offer, but maybe you should.
Oh, you know what, David? I don't have your microphone plugged in. We got to do that right there.
Yeah,
buddy.
I was just going to say,
in the back. All right, sorry about that. David sounded like he was off the mic. Yeah, he was off the mic. I apologize for that. Well, here's the story. The way that we get a property inspection waiver is we put the loan through Fannie Mae's underwriting system, and Fannie Mae's underwriting system is scanning then. It knows that property address, right? It has seen an appraisal before on 1234 Main Street, and it looks in its vast database because for about the past 5 years, we have been, as an industry, feeding property details into Fannie Mae on every single appraisal that gets done. And we're talking about thousands of data elements, right? Room sizes, number of bedrooms, bathrooms, square footage, the whole 9 yards. And so Fannie Mae is looking at its database, and it's deciding, hey, you told me that these parties agreed to a sales price of $260,000 based on what I know about this property and based on what I know of other properties like it that have sold in this immediate area. Do I believe with a high degree of confidence that 260 is good enough? And so when it rings the bell, and by the way, it always requires a 20% down payment in order to get the property inspection waiver. If it comes back and says, hey, you don't need an appraisal, then it's awesome. We're off to the races and we don't need one. Now, the issue is you're giving up negotiating power, however. And you remember we had the case that we talked about last week where the parties did agree to a $260,000 price. By the way, they were putting less than 20% down. And so they did not get the appraisal waiver, and then it came back at $235,000, a full $26,000 off the mark. And I'm happy to report that we were still able to make the loan even though the value was lower, because we just said, hey, we're going to pretend like we're lending you 95% of that lower number of $235, rather than the original plan was to lend them 10% of the $260. So it comes out to exactly the same loan amount. They didn't have to come with any more cash to closing. In fact, it ended up being $1,000 less. And after some hand-wringing with the sellers, that transaction has come together at a meet-in-the-middle price of $248,000. The key would have been, had we gotten a property inspection waiver, they might have missed out on that opportunity to renegotiate. But I think it's telling, having done this for a long time, there's a reason they didn't get the property inspection waiver at $260. It's because the property's not worth that much. So we could debate this back and forth, but in general, my belief, and David's going to take the opposite side of this argument when we come back, is I think if you get a property inspection waiver, 9 times out of 10, you should take advantage of it. And we also just got a news release from Fannie Mae saying that they are expecting, when they implement their next edition of their automated underwriting system, which comes out in December, that we're going to get even more property inspection waivers than we're getting now, and that it'll be possible to get one with as little as 10% down. So this is going to become more and more of a hot topic. Speaking of getting appraisals done, though, in a timely fashion, when we come back, I'm going to tell you about how long it's taking to get appraisals when you're buying property up north.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, the Bucks are off and running in the regular season, but it's without Chris Middleton. Just how much will his absence affect the team's win total? Greg Matzik dives in on that on Sports Central Monday night at 6:35 right here on WTMJ. We're in the midst of the Accunet Mortgage and Realty Show with Brian Wickert and David Wickert, talking about situations where appraisals can kind of trip things up a little bit.
Yep, especially when you're dealing in a less populated area. And so I've got a couple of examples here. I'm working on a refinance for some clients in Vilas County. We ordered the appraisal back on September 14th. Well, the appraisal just occurred, where the appraiser walks through the property and takes pictures and measures everything 6 weeks later on the 26th. And we're supposed to get the report on November 8th. So we'll be
moving a little slower up there.
Just a week shy of 60 days on that one. Let's call it 53 days.
Well, and just to remind everybody, mortgage guys aren't allowed to pick up the phone and say, "Hey, Mr. Appraiser, can you get out there anytime faster?"
Well, we can ask,
sure,
and, pay a rush fee. But the fundamental problem is this. Appraisers are getting older, like a lot of professions, and young people aren't going into the appraisal business. So appraisers, the supply of appraisers, professionals who are licensed and experienced, is getting smaller and smaller. And then when you combine that with being in a rural area, where, that thins the herd even more, you get these slow turn times. We've got another one that we talked about on a previous show in Park Falls, which is in Price County out in the western part of the state. That one we ordered the appraisal on August 9th. We did get a version of the report back. This is the one where the buyer and seller agreed at $260 for the price.
Yeah.
The property had been on the market for a year at $299, and the appraiser comes back and says, "I think it's worth $310."
Whoa!
And the QC department at the appraisal review area said, "How can that be? Because it was on the market
I don't necessarily
for a
believe
year,
okay.
And this particular appraiser just dug in his heels and said, because I said so.
Okay.
And that's not acceptable. By the way, the adjustments on that appraisal, when you take the raw sales price of the comparable sale and then you say, well, but it's a little better in this regard, it's a little worse in that regard, those adjustments are never supposed to add up to more than 25%
Yes.
of the base price. On that particular report, it was 80%. For one comp and 100% for another, making it completely
not comparable.
Unusable.
I don't think that's not the right word.
So we're on our second appraisal now on that deal, and we hope to have that back now maybe next week.
Okay.
So that one's going a little faster. We're going to get it back in 4 weeks, basically 4 or 5 weeks.
Faster being a comparative, yes.
Comparative. So the lesson, the takeaway is if you are buying in a rural area, leave extra time, or, don't think that you can get it closed in 30 or 45 days. 60 days at a minimum.
Yes.
60 days at a minimum. All right. Now, we've got a lot coming up on the economic calendar this coming week. And, David, I teased it earlier. Which way are mortgage rates going? Are they going up or down?
They're going up.
Yep. They've been creeping up. When we come back from this next break, we're going to tell you a little bit about why things are going the wrong way, and then also some upcoming economic events other than the election that could roil rates further when we come back from this next break.
And if you have a question, you can join us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, in just 3 years, Micah Hyde has become an integral part of the Green Bay Packers. But who's Hyde off the field? Hear an in-depth exclusive interview with the Packers safety during Packers One-on-One coming up with Greg Matzik at noon today, sponsored by Pella Windows and Doors of Wisconsin. Right now, it's the Accunet Mortgage and Realty Show with Brian Wickert and David Wickert. We got a lot of economic news coming up here that could affect things.
Absolutely, and let's start things off with a rate roundup. You know, I was just thinking, years back, you used to have Aaron Copeland's Hoedown play when you would do this.
Yes.
I'm just saying, I missed that. I wish I was played in my playing music. But anyway, today at Accunet Mortgage with 25% equity and all the other right stuff on a $200,000 mortgage, Accunet could offer, I'm going to lead with the no closing cost option,
all right,
and let's talk about that. Accunet could deliver 3.625%. The APR is the exact same. And if you wanted the eighth lower in rate, because pricing rates got a little worse this week, Accunet could deliver 3.5%, but that would be with 0.3 of a point, and the APR is 3.54. That's about $1,800 in cost.
How long could you get that loan for?
How long?
How many years?
For 30 years.
What about the 23-year loan?
It's the exact same.
So
customized loan length.
Yeah. Are you doing many of those?
A handful for those folks who are a couple years in and either, don't want to reset the clock or actually might want to lop a year or two off. We can keep their payment the same, but if you lop off that 2 to 3 years, that can be a real difference maker. The last item is on a 15-year fixed, still very popular, 2.875%. APR is 2.9. That's with $1,100 in closing costs. You got a question this week on how can Accunet cover closing costs?
Yeah, I had a customer at a closing. I always like to try to say hello to people when they come into the office and close their loan. And he was very complimentary, really enjoyed the process. It was great. He said, but I got to ask you a question. He said, can I ask you a question? I said, sure, ask me anything you want. He said, how is it that you don't charge like a loan processing fee or an underwriting fee or any fees whatsoever, and then on top of that, you paid for our appraisal and title and closing? And so that was the question, David. You got to go ahead.
So the one that we coach up our loan consultants, I mean, it's kind of simple. A mortgage at 3.625% is more valuable in the world on Wall Street than a mortgage at 3.5%. Because the 3.625 spits off more interest over the life of that loan. And so when you walk up to Wall Street and say, I got a mortgage I got to sell, Wall Street says, I will pay you more for that 3.625% than the 3.5, because it, again, is going to spit off more interest.
We can take the extra money.
Because what is someone's mortgage is someone else's
bond.
Investment.
Right, investment bond. So, yeah, that's the simple answer.
Yeah.
And then we just choose not to charge some of those other fees that other lenders get away with. And, that's why typically compared to, let's say the nation's largest online lender, the one that rhymes with Schmicken and who has a
skyrocketing cost.
Literally, and we have a comparison on our website, our closing costs are $3,000 less, sometimes $4,000 less for the same rate, same attributes as those guys. And that saves people a lot of money.
All right, so what's on the calendar coming up this week?
Okay, well, we have a Fed meeting coming up this coming Wednesday, and you were looking up for us, David. The chances of the Fed hiking rates this week is a whopping
8%.
Aha. But the chances of them going ahead with the rate hike at their December meeting is up to
74%.
In other words, they're going to raise rates in December. That's the current
Well,
thinking.
and that was part of the reason why rates ticked up this week was more it's this continuing steamroll of good economic news that's kind of making everybody comfortable.
Correct.
For the Fed to raise rates.
The gross domestic product, which is the measurement of all the goods and services that we produce as a nation for the third quarter, so that's July, August, and September, that number came out this week, and it was plus 2.9 on an annualized basis. That's a really good number. We've been kind of stuck in the twos. The expectation was 2.5, so that goes into the plus column. Hey, economy's getting better. That's what the Fed wants to see.
Yep. To that, and even homeownership rates went up this week, according to the Census Bureau as well.
Up to, what is it?
63.5% of Americans are homeowners.
And we've helped that, David. I want you to know you personally have contributed to that uptick. And then the other thing, speaking of mortgages as investments, right? People make the interest payments, but other people are receiving that interest. Mortgage rates are impacted by bond yields around the world, and that was another thing that contributed to the uptick this past week in interest rates here on mortgages was that the fact European government bond yields are back up. For example, Germany had a negative interest rate on their 10-year government bond for a while. It is now back up to 0.16%.
Zero. Okay.
The Netherlands is also way back up to 0.27, although there are still some that are underwater. All right. When we come back, what are we going to talk about?
I want to talk about the difference between getting that starter house and getting that forever house, especially when it comes to those 20 and 30-something first-time home buyers.
All right. When we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ. It's now 10:30 as we head over to the WTMJ 24-hour newsroom and an update with Colleen Boland.
Thank you, Steve.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
David Wickert is with us. Brian Wickert is with us. And we're at this point in the Accunet Mortgage and Realty Show where we're focusing in on millennials. And, do you go for the starter house or do you swing for the fences and go for the forever house right now?
Well, yeah, and so this was a debate that I had when I bought my first home, which was, I'll frame this in terms of Milwaukee. It's like, oh, honey, let's buy a house in Wauwatosa, and we'll live there for 5 to 7 years. And then, oh, you know what? We'll sell that house, and we'll buy some shack out in Pewaukee.
Okay.
And buy that forever home. But really, the on the math side of things, that can be perhaps a little bit more expensive than just, Steve, as you said, going for it from the word go as a first-time home buyer. And so, really this can be a conversation about, well, maybe you don't need all those rooms or that square footage in your forever home yet. It's just that there's no guarantee that you could turn around on that starter home and make that leap. And the numbers kind of bear this out. Of course, I did my numbers, and then, Dad, you jumped into it, and you've got your set of numbers. But I'll just note that even from an interest rate perspective, right now, as we said in the rate roundup, Accunet could do 3.625% with zero costs. Okay, well, whenever that day arrives when rates go up, let's pretend it went up 1% to
way up to 4.625.
What was your first mortgage rate, by the way, on your house?
It was
30?
ridiculous. No,
okay.
It was double digits.
Okay, but that would move your payment on a $200,000 house. You'd be paying $116 more per month for the same loan. And that doesn't take into account, well, what if home prices rise in the period between when you buy your starter house and when you buy that next home? So
that's the one that I just did.
Okay.
All right. So I said, let's say you're sitting there looking at, okay, you know what, honey? Maybe we should buy that $250,000 house. That would be our forever home, right? It's got 3 bedrooms, 2 baths. If we ever decide to have kids, like we've talked about, we could raise our kids there, and we could have
plenty of
schools
space
and all that kind of stuff. All right. Here's the deal. If you have 5 years of 4% home price appreciation, this is going to surprise you. That $250,000 house now costs $304,000. And so then applying your deal of saying, hey, I'll put 10% down on that property, 5 years in the future versus 10% down on the $250,000 property now.
Yes.
Your payment goes from $1,500 to $1,890. So $390 more with 4% annual appreciation for just 5 years and a 1% rise in interest rate. That right there, boom, dropping the mic. That's why you want to buy as much house as you can reasonably afford today when rates are still low and prices are where they are. All right, when we come back from this next break, let's talk a little bit about the 13, what was it called?
It was the 13 things I realized after I bought my first house.
This isn't from David Wickert. He found this on the internet, but there's some good stuff in there when we come back from this next break.
Here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Dry Hooch is more than just a coffee shop on Milwaukee's east side. The founder and owner of this unique establishment discusses the services they offer to veterans during this weekend's edition of WTMJ Conversations. You can hear that discussion coming up here at 11:07 this morning here on WTMJ. It's now 10:43 on this Sunday morning, and David Wickert shares with us 13 things he learned after buying his first house.
Well, and I guess that's not wrong. I learned this. It's just someone else put it in a nice list. So I'll just give credit to Callie Geldis over at credit.com. All right, so the 13 things. I won't belabor this. Here we go. Number 1, recycling and trash aren't necessarily provided by your county or your city. Number 2, get ready for higher utility payments. Number 3, air filters. You have to change them more often than you might think. Number 4, a big yard is beautiful, but not a lot of fun to maintain, especially here in fall time. Not to mention
the big oak trees and the maple trees. Yeah.
All right, number 5, buy a snow shovel immediately, if not sooner. Number 6, you'll be going to home improvement stores a lot. Just get that Menards card from the word go. Number 7, gutters fill up very quickly, especially here in fall time. Number 8, make sure your home inspector looks at the outside of the house, too. It's not just the things on the inside that you might want to pay attention to.
He must have had a problem.
Something.
Come up with that. Number
9, don't buy furniture just to fill space. We've had that question a lot the past couple weeks, like, suddenly I'm getting all these mailings from Colders that hey, save on your furniture. I think it's because...
While they're in process?
Well, because I think the credit bureaus sell that info.
Oh, that trigger lead.
Yeah.
Interesting. Okay.
Anyway, number 10, the first time you make a fire in your fireplace, make sure you own a fire extinguisher.
I like that one.
That's your favorite? Number 11, your local library has got a lot of resources for home and lawn care advice. I would add to that you can YouTube just about any home improvement thing you need. Number 12, your credit score might actually be improved once you get a mortgage. If you make consistent payments on this new installment loan that is the most favorably
rated. It's big, it's bold, it's important.
Yes. And then number 13, renting is so much easier.
I can't believe I let you say that on the air.
Well, it's not that it's easier, but that's, it can be worth it because as we say a mortgage is a forced savings plan.
It is. It's a forced savings plan because you pay an increasing amount of principal with every payment that you make.
Yeah. Well, and you were just saying on our last segment, hey, parents and grandparents.
Correct. Yeah. When we went to break, that's probably clearly the research shows, and article upon article shows that the biggest obstacle to buying a home for a first-time home buyer is the down payment. And this time of year, as we're coming into the holidays, Thanksgiving, Christmas, just an idea, parents and grandparents out there, why don't you help that millennial in your life, if you've got the means, and give them a gift and specify, hey, this got to be used for a down payment on a house. And with first-time home buyers in Wisconsin, we have, depending on the income, and we've covered this before, 3% down is all you need. We actually have 0% down, so, don't have to have the gift from a relative, but that just always helps. But 3% down is all it takes. And think about it. 3% down on a $200,000 home is $6,000. If that's what's holding you back, maybe grandma, grandpa, aunt, or uncle can help out. Maybe you've got half of it saved up. David?
I'll just be a little snarky. One of the things maybe a parent or grandparent is nervous about is, I'm going to give you this gift, and then you're going to go do something with it that's something other than make a down payment on a house.
Well, how could they control that, David?
One of the cool parts, and we talk this through when we're talking to first-time home buyers, is the gift from said family member can be made directly to the title company and does not have to travel through the checking account of Junior in order to arrive at the closing
In fact,
table.
it's easier from a documentation standpoint, we have discovered over the years, for the donor of the gift to make the gift at the closing table rather than before. Because if they give it to them in the form of a personal check, guess what? We have to demonstrate that that check cleared the donor's checking account.
Yeah.
That's rather intrusive. We got to get a copy of the back of the check to show that it really cleared. We got to show it going into the recipient's checking account. That's a pain in the neck. So a little bit of control and just ease of documentation on both counts. All right. When we come back, I want to cover what are the current motivations for refinancing. One of them is that upcoming Fed expected rate hike in December, when everybody's rate on their home equity line of credit is going to go up. But there's another really good trick that I wish more people would take us up on. And we'll give you that trick when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert is with us. David Wickert is with us. And we're now talking about refis and, the factors that go into deciding, should we be heading down that path?
Yep. We are fortunate. We've been in business now a little over 17 years. We have a lot of really loyal clients, and two of those clients, husband and wife, Rob and Carol, who were in the office for 2 closings this week because they have a Wisconsin property and a Florida property. We've done 9 loans for them.
Wow.
Since 2007. And so just as a reminder, we do lend in Florida. We took their rate on their Florida condo from 5% down to 3.75. Nice. And then we also refinanced their Wisconsin property as well. And here's the trick that I wanted to bring to people's attention. And I've been mentioning this on and off in radio commercials. On a $150,000 loan balance, let's say you had 27 years remaining at a rate of 4.125.
Yeah.
If you just lower your rate 0.5% down to 3.625, and then shorten the term to 25 years, are you ready? You would save $20,000.
Wow.
Of interest over the remaining life of the loan, net of your upfront closing costs on that loan. That's impressive. And by the way, here's the part that I sometimes don't mention in the radio ads because of time. Your payment would still go down $7. So you cannot do this magic without the 0.5% rate reduction. And yet millions and millions of Americans in Milwaukeeans still think that your rate has to go down a full percent.
Yeah.
That just is, and so they go like, yeah, the rates aren't low enough for me to refinance. And that's just not true. You were going to say something?
No. What I really like that our loan consultants do is we'll lay out that option, and then we'll also say, or you can go back out to 30 and get not only the drop in rate, but also the benefit of better monthly cash flow. And then, not to sound like a broken record myself, but I always say you can pay that mortgage faster,
right,
if you want to. If you just want the choice.
By the way, I just ran the number on that. If you, on a $150,000 loan now, if you stretched it back out to 30 years, you wouldn't be committing any sin insofar as you'd still pay $2,000 less of interest by lowering your rate 0.5%, and your payment would go down $84 per month. That's $1,000 a year.
That's still real money in 2016.
Maybe you could put that towards your retirement or something, because goodness knows people aren't doing enough of that, or paying off some higher, interest rate debt that you have out there.
Very true.
Now, the motivation, with the home equity lines, as the Fed gets closer and closer to kicking up the Fed funds rate, that will have an immediate impact. Remember, we said earlier in the show, 74% chance right now, according to the Fed funds futures market, that the Fed will raise rates at their December meeting. As soon as they do that, everybody with a home equity line of credit tied to the prime rate, which is all of them, they are going to see an immediate increase in their interest rates. So we've been doing a lot of consolidations, I will call it, where we're helping homeowners who have a significant balance on their home equity line of credit, combine that with their first mortgage balance, and then lock in a low fixed rate on everything. A lot of people are doing that on 15-year fixed rate loans right now.
Well, because it's interest rate risk management.
Correct.
And there's nothing that would prevent you from combining both of those together and then going out and getting a new home equity line of credit just for that security blanket or whatever it might be.
Yeah, I have a home equity line of credit on our house here just for emergencies that I don't know if I've ever used it, but it's kind of nice to have, around in case something.
Because when you need it is when it might be hard to get it, that kind of thing.
That is what I've always said.
Okay.
The other thing, if you've had your house for a couple of years, and maybe you bought it and you were paying private mortgage insurance. Well, guess what? Your house has probably gone up 5, 10, 12% in value.
Well, and with a strong summer of sales to look back on,
we might be able to get rid of that PMI for you. And even if the rate stays the same, that can oftentimes be $100 or more in savings. And then, of course, there's always the home improvement situation. I've got a couple of these personally going on right now where, people want to redo their kitchen and they're going to spend. Kitchen remodeling is expensive. $50,000 easy. And so the choice is, do I keep my rate that I might have at, 3.75 on my first mortgage, and then go get a home equity line? Well, what a lot of people just aren't savvy enough to know is that if you get a home equity line of credit, that's a variable rate.
Yep.
And if you get a home equity loan where the rate is fixed, those rates are a lot higher.
Yeah.
And so we're doing a fair number of cash out refinances. And, I would say the going rate on those right now, depending on your credit score and all that, would be about 3.75. So we can do a blended rate analysis as well and say, well, if you do it on 2 separate loans, this is what your blended rate would be.
Yep.
If you put it all together, here's what it would go down to. Remember, we make it really easy to refinance. We are now on top of our game relative to e-sign. People really are loving that. There's a chance that you won't need an appraisal. We talked about property inspection waivers earlier in the show.
And before we end today's show, I just want to emphasize the rock solid pre-approval. I know we're past summer buying season, but for the number of homes that are still on the market, I just in the front lines of loan consulting that I participate in, the amount of heartburn that we can reduce by doing that homework before you get out there and start writing offers on homes, I think can't be overemphasized in the emotional transaction of buying a house. It's not only about lining up the numbers, it's about making everybody a little less stressed.
It is.
When they're going to buy.
Right. Home buying is stressful, and that's a really good point. The rock solid pre-approval that we offer does really put the home buyer and the agent at significant peace of mind. We have another show next week. We've been on a great streak. We love it when the Packers have the late games because then we get to do the show every week. So, that'll be our last show before the election, but we will have the latest jobs numbers under our belt. Anybody who wants to still lock in a good rate on a refinance before that jobs report on Friday can do so by clicking on the blue button at Accunet.com. That's ACCUNET.com. Thanks, Steve. We'll see you again next week.
You've been listening to the Accunet Mortgage and Realty Show on 620 WTMJ. We'll check in with Colleen Bolin next in the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.